Good morning, everyone. In fact, we are just coming up on the date that the version after a long time. Sorry for the delayed version because of certain inconvenience on the personal front, right? So we will see the basic journal entry, which is in continuation of our day two classes. Let us see the recap of day two. We have discussed definition, procedural aspects of accounting. Accounting means recording, classifying, summarizing, interpreting of financial transactions. We also discussed about objective of accounting, functions of accounting, and then we also discussed about fundamental accounting equation, capital is equal to asset minus liability. That is also called as a balance sheet equations. And then we discussed about relationship of accounting and bookkeeping. Let us slowly and steadily getting into approaches to journal entries. There are two approaches. One is modern approach, another one is a traditional approach. Mostly we use traditional approach, but we will see what is modern approach and then go to a traditional approach, see one or two journal entries, and then next sessions we will see more journal entries of various types. Modern approach, as a modern approach, all the financial items can be classified as capital and then asset and then liabilities and then expenses, and finally we have a revenue or a sales. So modern approach, we group all the elements of accounting into five major basket or bucket. One is capital, second one is revenue, third one is expenses, liabilities and assets. Capital also liabilities, but when we talk about liabilities, which is outside liability, which is borrowed from outside. Right. So let us see the modern approach. We have asset. When we purchase asset, the expenses increases. That means debit side increases, credit side decreases. When we have a liability, that is revenue or capital, what will happen is debit decreases, credit increases. Right. So the modern approach, which clearly talks about asset and liabilities, asset increases, liability will adjust accordingly. That is what we are talking about. That in terms of traditional approach, very important. We were using this approach in our modern accounting system. We have a three type of account. One is personal account. These accounts related to persons like debtor, creditor, for example, Raman Co, State Bank of India, Tata Motors, etc. We have a nominal account. Here we are talking about all the income and expenses or gain and losses. For example, interest paid, commission received, purchases, sales, training expenses, so on, so on. Then we have a real account also. Real account, we talk about all the asset of the firm, which may be tangible or intangible, like land, building, cash, patent, copyright, software, computer, etc. So, nutshell, I just reclassify again. We have a three type of account: personal, nominal, real. Personal is which related to individuals, companies, debtor, creditor, etc. Nominal account, all income and expenditure, gain and losses come under nominal account. Real account related to asset of the firm, which include tangible or intangible. The classic example is land, property, plant, building, equipment, etc. So let's see the golden rules. Personal accounts, debit the receiver, credit the giver. This is the golden rule which you have seen on last class also. But please remember, these rules are very important. Real account, debit what comes in, credit what goes out. Personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. In terms of nominal account, debit all expenses and losses, credit all income and gains. Okay. So let's see the important journal entries. How do we do that? So nominal account, debit expenses, credit income. Real account, what comes in is debit, what goes out is credit. Personal account, debit the receiver, credit the giver. These are all the rules. Let's see the journal entry one by one, right? Let's see how it works. We see started or commenced a business with 20,000 rupees. Here there are two accounts. One is cash account, another account is called capital account. Started or commenced business with 20,000 rupees is a capital. Cash is coming in. Cash is a real account. Cash is a real account. When we say cash, we say cash is real account. Capital is a personal account, right? What comes in is debit. So the cash is coming in here. The cash is coming in. So cash account debtor. Capital, debit the receiver, credit the giver. Who has given? Ram's capital, right? So capital is a liability, credit the liability or credit the giver. So cash account debtor to capital account creditor. Let's see the transaction 2. The goods purchased for 9,000 rupees, right, or a cash purchase. Here there are two account. One is purchase account, another one is a cash account. Earlier case cash was coming in. This transaction 2 cash is going out. When you purchase goods, the cash is going out. Purchase is a expenses. Purchase is a expenses nominal account. Purchase is a expenses nominal account. So all expenses are debit. Cash going out, what goes out is credit. Cash is a real account. So purchase account debtor to cash account creditor. Why cash is credit? Because the cash is going out. Right? Purchase is expenses. So all expenses are debit. Let's see the transaction 3. We have a goods purchase from Morgan for 18,000 rupees. It may be on credit. So let's see purchase account debtor to Morgan account creditor. Why purchase account debtor? Because purchase is a expenses. Purchase is a expenses. All expenses are debit. Morgan is a personal account. Debit the receiver, credit the giver. Here Morgan has supplied the goods. So Morgan has given the goods. Okay, Morgan has given the goods. So credit the giver. So purchase account debtor to Morgan account creditor. Okay. Goods returned to Morgan. Morgan admitted our claim of 100 rupees. Right? So Morgan account debtor to purchase return account creditor. Why purchase return account is creditor? Because purchase is debit, purchase return is credit. But we will see all these transactions much more detailed manner. Here we are given as a sample of how the transaction looks like to understand about the journal entries. So each journal entries we will classify personal, nominal, real, and then we will also discuss the rules and then how to make these journal entries in the next sessions. Right? So thank you so much, and please go through these basic journal entries. This will be the preview of next sections, and we will do the detailing of journal entries in the next class. Thank you.